Are you playing the market, or is the market playing you?
You done taken the wrong turn.
The MoneyLife Market Call helps you answer the question by discussing what's working in the investment world right now.
It's working. It's working. It's working.
It's real guidance about real investments from real experts.
I play at expert level.
You might find that next great investment you were looking for, or hear that it's time to sell something you expected to hold on to.
Let it go.
You'll learn how investment pros make decisions and what they see for the future.
See your future. Be your future.
You may be excited one moment and angry or frustrated the next.
Mr. McGee, don't make me angry. You wouldn't like me when I'm angry.
But that's just life in the market, as Chuck Jaffe talks stocks, mutual funds, and more.
I can live with that.
In the daily MoneyLife Market Call.
That's right, it's MoneyLife Market Call time, and if I sound excited today, well, nothing I can do can pretty much get me to half the excitement level of my guest. Brent Wilsey is here with us today. He is president of Wilsey Asset Management in San Diego, California. He's one of my favorite folks to talk to. He was always a great source for me on, and always has been, still is a great source for me, but has always been a great source for me, like when I was writing Stupid Investment of the Week and things like that, because Brent is very process and numbers driven. He has a great process that he adheres to, that he lives by, that he totally believes in, and that he's excited about. And that's why I say, if you like my energy, like I said, I sound down and unexcited as a general rule compared to Brent. Now, if Brent's words excite you and you want to learn more about what he's doing and his firm, WilseyAssetManagement.com, and follow Brent on Twitter where he's at Brent Wilsey. Brent, welcome back to the show.
Well, Chuck, great to be here. Thanks for having me.
I talked about the fact that you are numbers and process driven. So we have to start there, because a buy, sell, or a hold is meaningless until folks know what goes into it, and you have very specific things you look for.
You know, Chuck, and you're so right, because a lot of people just say, oh, sell that stock or buy that stock. They don't understand what's behind it, and you've got to look at these stocks. They're just small pieces of large companies is all they really are, and we look at the valuation ratios. What are you paying for the earnings, for the sales, for the book value? The cash flow of that company. What are you paying for this stuff? Don't overpay for it. If they pay a dividend, how much of the earnings are used to pay out that dividend? Very important. Can't believe you don't look at this, but the sales growth quarter over quarter, year over year, is the company growing their earnings quarter over quarter, year over year? And then to make sure you don't get stuck with a company that's going to lose all your money, go bankrupt, we look at the financial strength and make sure they have a current ratio that's very acceptable to make sure that they won't go bankrupt and don't want to have a company with a lot of debt, so make sure their debt to equity is low. And then we do look at how effective is management. And for that, we look at what's known as the return on capital, return on equity. We also look at things such as, very simple, the net profit margin. Is the company making a profit or not? And then we do look at the efficiency of the company, things such as receivable turnover, inventory turnover, and then to look at what the value of the company is going forward. We take the mean estimate of the analyst on a GAAP basis, which is generally accepted accounting principles, and use a 16.5 multiple on that number, which is a 40-year average, to say, hey, this is what the company should be worth year and a half, 2 years down the road.
So you put all that together. Now, I could focus on a lot of different pieces in there, but there are two that typically stand out to me because I think you value them perhaps more than some of the other folks we talk to who are numbers driven. One is you rely on PEG ratios much more so than PE ratios and some of the things that are more commonly used. And then you mentioned the current ratio. Those things seem to be two things particularly important to you that maybe a lot of other people don't put as much importance in. So why are they important to you?
Well, check the PEG ratio is very important. The PEG ratio is price earnings divided by growth. And there's a lot of companies that are growing and doing a great job, but you don't want to overpay for that. So you look at the price earnings compared to the growth. The lower the number, the better. We'll take a company with about a PEG ratio up to 3 times. If it's much beyond that, you got to ask, wait a minute, am I paying too much for this company? And the current ratio is a very important number as well for safety of the company, because if you have a low current ratio, that means that the company can't maybe pay their bills on the next 4, 5, 6 months. If they can't pay their bills, they could be forced into bankruptcy, and company goes bankrupt, you lose all your money. So you got to be careful, got to check all these numbers. And I will point out there's some that we really like, but they all have to be good, because if not all good, you could have problems.
So that's an interesting thing, because right now, as you talk about valuation, well, a lot of folks believe that valuations are high. If you have to have all the numbers lined up for you, are you finding that right now it's a little tougher to find things to buy than normal?
It actually is, Chuck, because we look at valuations overall, and there are a lot of great companies. We'll talk about a company today that's a great company. It's a cereal company, and it looks great, but it's just too expensive. And a Clorox, won't talk about it today, but a Clorox, just a basic company. I think that company is trading at 20 times earnings, forward earnings, and the average over the last 100 years is like 15.9. So people are paying too much for some companies, and they will come back down. Everything comes back down to the mean eventually, and you've got to be careful. Do not overpay for companies or businesses or stocks. It will come back and bite you.
Does the macro ever really come into play with all the numbers that you're looking at? Do you much care about the big picture?
I do, because you want to look at the employment numbers. You want to look at manufacturing. You want to look at we like a report called the JOLTS reports, which is Job Opening Labor Turnover Survey, and that shows me what the job numbers are really looking like and so forth. So we do look at that, but then we come back and focus on the micro side of, can the business do well if the macro side is doing okay? But if the macro side is not doing well, we're a little more cautious if we see problems down the road.
Okay. So let's talk about something that comes through and is sort of the poster child for you right now of this is where the numbers come together and make something a great buy.
Sure. There's some things that we're kind of looking at, and we like simple businesses that will do well and so forth. One that I like is a Kohl's, and their symbol is KSS. This is such a great retailer. I mean, this is a company for years has bought back their stock. They pay a dividend that is like a 4.4% dividend. Right now it's around $44 a share. I will get really excited when this stock falls down about 40, and I think we could have a pullback over the next month, we'll call it. We do know there's this small thing coming up called an election, which I think is going to create more volatility. So I'm hoping to get a Kohl's at a very good price, around $40 a share. I'm still big on energy. Energy, we do see it coming back now. We know that the Saudis are trying to cut production. I saw a thing the other day to where they're going to be talking to Russia about cutting production. So right now oil's around $51 a barrel from the West Texas Intermediate crude. I think by the end of the year we could see that around 60, maybe even first half of next year around 70. So there's some good energy companies out there. Chevron is a name we kind of toss out there. Chevron, a big oil company. I could see a gain on that of maybe 10, 15, maybe 20% over the next year, not including that you get a 4.2% dividend from Chevron. So we like retailers that are beaten up. And by the way, Kohl's had a high, I think at one point they're like $68, $70 a share, buying at 40. Chevron had a high, I think over the last year or two, probably around 140. Right now it trades around 100. So I try to buy that good value and say, where will that business be 2, 3, 4 years down the road? And Chuck, remember, I get to collect that 4% dividend plus over the next few years as well. And companies do have a history of raising their dividend as well.
What makes you sell? Is it 1 ratio changes, 2 ratio changes? What's the case of something that you sold recently and why?
Well, what we sold recently was Wells Fargo, and that's a good example because Wells Fargo had great numbers, great fundamentals in the past, and we bought Wells Fargo back in 2009 when nobody wanted it. We bought it, done very well with that company, but I saw that with the situation with Wells Fargo, they've got lawsuits coming up. The CEO is gone. They got changed direction how they do business. This is not the same Wells Fargo, so we said, different company, we're going to get out of it. Most of the time we'll sell a company when it surpasses the valuation of the 16.5, or what we call the target price. We won't overpay for a company, and we'll sell it at the average of 16.5. So if we buy it at $10 a share, we'll say, and you multiply the earnings times $1, and that's a $16.50. If it's $16.50, we'll say, you know what, that's a good price. We'll go ahead and get out. So we're very reasonable. We don't try to get all excited and wait for things to explode. We'll say, it's 16.5, $16.50. We'll sell that company.
I mentioned that you have been helpful to me as a source, and you and I were speaking recently for a freelance piece I was doing where you were talking about gold. And that's not something I normally expect you to be going into, but you like the outlook for gold right now. Explain why.
And that's right. I mean, people are saying, Brent likes gold? What's going on? Why so crazy here? And what it is that I do believe, the labor market's getting tight. I do believe we're going to have inflation over the next 2 to 3 years. And gold is a very good short-term inflation hedge. It's not a great long-term one, but on the short term, that will do very well. Now, in the meantime, you will see businesses, their stock prices probably drop on the short term. But long-term stocks are a great inflation hedge because what are stocks? They're businesses that have a product that they're selling. And what is inflation? Inflation is rising prices on products. So shareholders benefit when prices go up because the earnings will rise. Short term, not as good, so you hedge your portfolio with maybe a 5, maybe a 10% percentage in gold. I don't think I'll go to 10%, but I will put some gold in the portfolio.
Well, now we're going to find out how you feel about some stocks that my audience is particularly interested in.
Play, hold it,
You got to know when to hold up.
or fold it.
Know when to fold up.
We've come to Hold It or Fold It time with my guest, Brent Wilsey, president of Wilsey Asset Management in San Diego, California. WilseyAssetManagement.com for more information. At Brent Wilsey on Twitter. Hold It or Fold It is where we put our guests to your test, and if you want to participate directly, send your name, your hometown, and the ticker symbols you're interested in to Chuck at MoneyLifeShow.com. We'll add it to our list and hope it makes it into an interview soon. And somebody who sends us requests fairly regularly is Dale in London, Ohio. Brent, you mentioned a cereal company. This is it. It's Kellogg, ticker symbol K.
Yes, Chuck, I was hoping this would be a buy because, again, we know the product Kellogg. I mean, gosh, I grew up with it. I'm sure you did as well. But I looked at it. They have no price to tangible book value, which means you take away all the tangible assets or intangible assets. There's no value to the company, so I didn't like that. You do get a 2.8% dividend, but they use 114% of their earnings to pay it out. That's not a good sign. Their earnings did look pretty good, up 64%, but their sales are down 8% year over year. So how can you grow earnings at that rate when sales are going down? Not a good situation to be in. And then what the big kicker was when I looked at the current price, somewhere around $74, $75 a share. When you take that multiple of 16.5 times the earnings going out to December 2017, I get a target sell price of 66. So it's over the 66. So this is a sell.
Oh boy, that sounded bad.
He said it. It's a sell on Kellogg, ticker symbol K. Mark in New York City wants to know about DR Horton Incorporated, DHI.
You know, Chuck, I am so excited about the builder industry, and we mentioned earlier about the energy and so forth. The building industry is another one I was very excited about. And D.R. Horton, I look at this company, you got a current P/E ratio right now of 12.9. You've got a price to book value of 1.68, and that compares to the industry to 11.2. So D.R. Horton, you're paying a great price for the tangible assets of this company. Their sales are up 14% year over year, earnings up 22% year over year. And they only got 50.7% in debt, so they're doing a great job doing that. Looking out to September, they're in a fiscal year. September 2018, they have earnings of $2.19. Put the multiple of 16.5 on that. You get a target sell price of $48 a share. Chuck, right now the stocks are on 29. Building is going on. We have a shortage of housing that I think over the next 2-3 years, we're going to have a lot of building going on. I like D.R. Horton.
Oh, that's beautiful. We could make a fortune.
That's a buy on DR Horton, DHI. Brent in Chandler, Arizona wants to know about Toro Company, TTC.
You know, Chuck, here's another one I was excited about because, again, I remember Toro lawnmowers and so forth. Like, wow, I want to get into this company. Well, I kind of looked at it, and I got kind of disappointed because you got a price to tangible book value of 18.7, double the industry. Sales are looking pretty good, up 3.5. Earnings up 20%. That was positive. The debt to equity is positive, 61.8. You got a nice return on equity of 43. You got all these great numbers here, but I think it's all built in because I went out to October 2018 looking for earnings at $2.57. Put that multiple of 16.5. You had a target sell price of $42.41. Right now, well, the stocks are on 47, so I was kind of kind for the hold here, but I got to be honest, Chuck, it's not a hold, it's a sell.
Warning, warning, warning.
Yep, you heard it. It's a sell. It could be like if you feel strongly, maybe you'd keep it as a hold, but Brent ultimately had to put a sell on Toro Company, TTC. Joe in Colorado Springs wants to know about 21st Century Fox. That's ticker symbol FOX, and then there's Class A and Class B on that company.
You know, Chuck, and this is really in the news a lot of times. The local news last night talking about the AT&T merger with Time Warner and so forth. So this industry has a lot of changes going on with content and cable and all these different things. So I looked at 21st Century Fox, and they don't have a price of tangible book value, and that's not my favorite. But again, they have a lot of business they bought over the years, so you got to understand how that's going to work. The numbers don't look that great because last year earnings are down 63%, sales down 5.7. Their debt's a little bit heavy at 144%, but I think this company, if you read deeper into it, you're going to find some good things. What I do like is going out to June 2018. You have earnings at $2.11. That gives you a target sell price of $34.82. Stock right now trades around 25. So I think on top of that 1.4% dividend, you could see growth about 35% in the stock price. So I like this. And it's kind of funny, in the media area, a lot of companies right now are overpriced. This one is not.
Would you mind stepping aside? I've got a purchase to make.
That's a buy on Fox, 21st Century Fox. And last, for Josh in Petaluma, California, Roper Technologies, ROP.
Well, Roper Technologies, I looked at their price of sales, and there's, again, many different metrics you can look at. They're very high, 4.8 versus 1.5. That's very expensive for the sales. No price to tangible book value. Price to cash flow is 19 versus 12.2. And again, valuation ratios, you want them lower than the industry. Their sales are up 2%, industry down 4%. When I looked at their debt to equity, well, that looked okay, 55.7, about the same as the industry. Return on equity was 12.8, not as good as the industry at 17. And I did notice that the receivable turnover looked okay, about 6 versus 5.7. The problem, again, comes into what are you paying for the future earnings of this company? Going out to December 2017, earnings are expected to be $7.22. That multiple of 16.5 gives you a $119 target sell price. The stock right now trades around 171, just too pricey for my blood.
Put that one on the psycho list.
So that's a sell on Roper Technologies, too pricey for Brent's blood, ROP. And sadly, we've come to the end of our time with Brent Wilsey. But Brent, it is always great to chat with you. Thanks so much for taking the time out to join me on the show.
You're welcome, Chuck. Thanks for having me.
Brent Wilsey, everybody. He's president of Wilsey Asset Management. It's wilseyassetmanagement.com. On Twitter, he's at Brent Wilsey. All right, we're just about done with the October 25th show, but we'll wrap things up together, and we'll tell you about the rest of the week before we send you home for the day right after this message.